Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. In both private and public limited companies, dividends and share buybacks are the main ways to return value to shareholders. Dividends provide regular income and are straightforward, especially for owner-managers, but they must be supported by sufficient profits and may have less favorable tax treatment in some cases. Share buybacks reduce the number of shares in circulation and can increase shareholder value. Companies usually choose to buy back shares when they have extra cash, want to return value, or need to support ownership transitions, such as retiring directors or departing employees. For public companies, buybacks can also signal confidence in undervalued shares. Private companies have more flexibility, often funding buybacks from reserves or fresh share issues. Tax implications vary depending on individual shareholder situations, but buybacks can sometimes be more tax efficient since proceeds may be treated as capital rather than income. Ultimately, the decision between dividends and buybacks depends on tax, governance, and strategic factors unique to each company. Share buybacks come with specific limitations, including the need for strict statutory compliance, such as obtaining shareholder approval, and they tend to be more complex than dividends because of the legal documents and filings involved. For public limited companies, dividends are commonly used because they offer predictable and stable returns, signaling financial stability to the market and attracting income-focused investors like pension funds. However, dividends can create an expectation for regular payments, which might limit a company's ability to reinvest, and their tax treatment can vary, sometimes being less tax efficient compared to capital gains. Share buybacks, on the other hand, are carried out on the open market under stock exchange rules and usually require shareholder approval. They reduce the number of shares available, which can improve earnings per share and potentially raise the share price. Buybacks also offer flexibility, allowing companies to adjust their programs based on market conditions and can indicate management's confidence in the company's value. The downside is that buybacks may be viewed as a short-term strategy that prioritizes share price over long-term growth, and they require careful compliance with regulations around market abuse and insider trading. In private companies, dividends remain the simplest way to distribute profits, while buybacks are useful for shareholder exits and tax planning. For public companies, dividends provide stability and build investor confidence, whereas buybacks offer more flexibility and can boost market performance. Ultimately, the decision depends on what shareholders expect, tax considerations, and the company's strategic objectives. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.